Hey, how's it going, everybody? It's Mike Weber here, and today I wanted to go ahead and cover some recent news that's coming out about the national real estate market. Always trying to bring you guys as much valuable content and information about real estate as I can. And today I saw an article published by Business Insider that is talking about the economists at Bank of America Merrill Lynch, who are officially calling it and are saying from their perspective, housing has peaked in the US. So before I jump in and cover that article, I just want to talk a little bit about the general state of the housing market. So as most all of you know, the Federal Reserve has been raising the federal funds benchmark rate over the last, 3 or so years. And although they've been doing it very slowly, it is starting to go up a little bit. We're at around 2% right now. And most experts are saying that they believe that tomorrow the Fed will go ahead and raise the rate another 25 basis points or 1/4%. And likely, again, they will do the same thing before the end of the year. So that would push the federal funds rate up to around 2.5%. And then, of course, mortgage rates directly follow the 10-year Treasury bond rate, which of course is heavily influenced by the federal funds rate. And so that has gone up to a level we haven't seen in a very long time as well. I believe it's right around 3.1% for the 10-year, but we'll go ahead and take a look at that. So here's an article here on CNBC that was published today that's talking about the likelihood that the Fed is going to go ahead and raise rates tomorrow as well as in December. And it looks like all of the people that they surveyed or the people that they're talking about are essentially saying that it's almost certain, in their opinion, the Fed will be in fact going ahead and raising rates. So if we jump in here on Fred, and we look at the federal funds rate, right now we're hovering right around 1.91%. So if the Fed raises rates tomorrow another 25 basis points or 0.25%, that would get us up to around 2.2, 2.15, etc. And then of course that will have an influence throughout the markets, including in mortgage rates. Looking at the 10-year Treasury constant maturity rate, which is again influenced by that federal funds rate, we see that although earlier in the year it was up to a similar level, we are hitting a relatively high point here that we haven't seen for quite a few years. Next, let's take a look at this article that was published on Business Insider talking about the economists at Bank of America that are basically saying the most important segment of the housing market has peaked. And the segment that they're talking about is existing home sales, which they say makes up 90% of the transactions in the United States. So obviously this is big news. This is, big news coming from a big company with, qualified economists. And so if they're saying this is the case, it probably is something to pay attention to. And I certainly would expect there would be some credence to what they have to say. They cite worsening affordability, higher mortgage rates, and price cuts as reasons sales are unlikely to bounce back after peaking in November. They no longer expect existing home sales to contribute to the economy's growth. And the article goes on to go into detail about some of their findings and exactly what they're talking about. I won't go into too much detail here, but one of the major concerns that they're citing is affordability, which obviously continues to drop as interest rates continue to rise, as well as home prices continuing to rise throughout the country. In one other thing in this article that was interesting is they're saying that Zillow says that they're seeing the most price reductions in the market since 2013. And of course, I'm a real estate agent here in the Los Angeles area, and I'm certainly seeing the same thing myself. So let's jump into this article that was published yesterday by Realtor.com. The title of the article is Housing Slowdown, Softening, whatever you call it, it's real and it's here. And I will have links to all of the information and all of the articles that I'm looking at today down below, so you can go ahead and take a look at these articles and these graphs yourself. So basically this article is essentially saying that really the housing market is slowing down or not accelerating at the same pace as it was over the last several years. So they're not saying that housing prices are necessarily falling, but definitely they're not rising as quickly as they were before. there's also some other interesting infographics in here that are showing the median price change, which, in this case, of course, it was 9%, in August 2016, 10% year over year in August 2017, and only 7% as of August 2018. They show the inventory change, median days on market, and I think this is probably one of the, most interesting components. And they're saying, increase of 7% in the number of price reductions on homes. So they kind of go into more detail. They say that, sellers shooting for the stars may not be able to get quite as much as they'd like, and so on and so forth. And they cite also, similar things like rising interest rates, etc., as being the reason why or the cause for what's going on here. Here's another interesting graph that they have in this article here. And this is definitely interesting. They're saying change in reduction by county in terms of price reductions as a percentage. And as you can see here, I mean, there's a lot of areas that are in this kind of, lighter to darker orange sort of area. And in fact, some parts of California have seen massive increases. I'm assuming this is year over year in price reductions in those areas. And so this is definitely interesting and something to, keep a close eye on as we move forward. And here's another interesting article by Market Watch that was published today that talks about home price gains decelerating to an 11-month low as the housing market tries for a soft landing. Now, obviously, lots of major cities are still experiencing double-digit gains. However, a lot of cities are not gaining at the same rate as they were before, and so that's what they're talking about in terms of a deceleration. Here they say in July, based on the S&P CoreLogic Case-Shiller 20-City Index, we had a 0.1% increase, seasonally adjusted, and that was up 5.9% compared to a year ago, which obviously isn't as big of a gain as we've seen in some of the past years. So here they have the 20 cities outlined here. This is pretty interesting to look at because, we're seeing, I don't know, probably, an average of, 5.9%, which would make sense. And so, a lot of these cities, were in double-digit sort of overall year-over-year gains for a long time. And now most of them are slowing down substantially. We're not seeing any negative numbers here, which is definitely a good sign. But obviously, the growth has definitely slowed. Now, one last thing I want to take a look at is this chart that you can get on Fred, median sales price of houses sold for the United States. And this is interesting because I'm not seeing this really covered anywhere or, on any news sources or anything like that. And I'm not exactly sure how they calculate this and why it's different than what we're seeing on some of the other charts and graphs being used. But that being said, I do want to show it to you and bring it to your attention. And what you see here is that Q4 2017, we hit a peak, and Q1 2017, we dropped down to 331,800. And then again in the end of Q2, we dropped down to 309,800. So if you see that there, I'll go ahead and make it a little clearer for you. I mean, we've definitely peaked here according to this chart in terms of median sales price of houses sold in the United States. And for the last 2 quarters, we've already been falling. So I'm assuming these are the houses that have actually sold, but definitely something to keep an eye on and take a look at. So if this information was valuable or useful for you, do me a favor, go ahead and subscribe, click the like button, so that way you'll continue receiving videos like this. And if I can help you with anything real estate related in the greater Los Angeles area, definitely reach out to me, give me a call anytime. Thanks so much for watching, really appreciate it, and I'll see you next time.